This is our Forex blog for January 21st, 2011. One of the things that we like to do to start each day trading is to look at our currency meter. Yesterday the dollar is very weak, but it gained some strength throughout the day, and the weekly trend had shifted back up. The monthly trend is still down, which is something to be concerned of. If the weekly trend is just slightly up and you see strength, you can trade it. But if you also see intense weakness with a just slightly up weekly trend and the monthly trend still being down, you can trade it on the short side. So let's say at 1 o'clock here, when you see some weakness come in, what is the strongest currency at 1 o'clock to trade it against? Well, it's pretty obviously right here, the euro, incredibly strong, and the weekly monthly trend is one of the strongest. The euro and the pound are the strongest. So at 1 o'clock, you want to buy the strong euro versus the weak dollar. And you can see at 1 o'clock here that the dollar was weaker than the yen, and the yen didn't have a monthly trend that was down like the dollar did. It actually shifted down last night at around 10 o'clock Eastern time. So at 1 o'clock, again, we're looking to look for buys in the euro dollar. And even before that happened, we had a multiple sideways, very low volatility range. Our NR7 pattern showed up on here, and usually breakouts of this pattern, if the price is above the hourly, you want to buy. If the price is underneath the hourly, you'd want to sell. And you primarily want to focus on this in the direction of the weekly monthly trend, which is up. So you got into this trade right here at 84, and it went up to 14. So you could have made 30 pips on that trade. And whether you got out here or when it double topped with no statistical strength, the first time up it had a lot of strength. When it double topped, it had no strength at all. So while the euro dollar is going up against the dollar, our statistical tools are telling you that the euro is falling against other pairs, and the dollar is actually gaining some strength, and that's why you see this. It's, take your 20 or 30 pips profit and get out. And a lot of times currencies find support here at the hourly. This is a great place to get back into this trade because the weakness on the way down was nothing, first of all, and secondly, it was less than half of what the strength on the way up was. So after it goes sideways there for a little bit, 5, 10, 15 minutes, you buy the breakout here. And once the IntelliTrend bars go green, usually if you're trading in the direction of the weekly monthly trend, and if the price is above the hourly, it's likely to go up. Now it hit the upper containment band here, or kind of stalled out at the previous high. I would have probably exited half my trade there and maybe got out of the rest here. 1 o'clock, you're looking for pullbacks. You might have found support at the balance point line. There was another 25 pip move. Pulled back again. It's having trouble here at the previous day's high. When it finally breaks out the second time, you might get in, and look at how our fib levels held. This was an area that I drew on the chart on my charts last night, uploaded to the server, and they automatically show up for any of our mentor students. And it's a great place to get out, especially when it's above the upper containment band, and especially when it doesn't have that much statistical strength. And you might have also bought this little pullback right here. You probably would have lost on that trade, and then you draw your fibs on this first wave down, and we have a perfect Elliott two-wave pullback. It's one of my favorite trades, not only because it's very high winning percentage, but the farther down the market goes, as long as the trend's up, the more likely pips you're going to make if it resumes. Now if it doesn't resume, you're going to have a small win or a small loss. But if it does resume, it came right back up to this level again, didn't have off the chart strength, but you're in this trade somewhere around 10 to, let's say, 15, out of this trade at 50, so you made 30 plus pips. And again, it pulled back. I'm not sure if I would have bought here, but as long as it stays above the previous day's high, it kind of goes sideways right here, you might have bought that breakout, made 10 pips. I probably would have got out of the trade somewhere up in here and missed the remaining 20 or 30 pip move. But it's a good trade, and the currency meter, helped you spot it. Another one, like I said, the pound at 1 o'clock was strong. It didn't have the continuation strength that the euro had, but you might have been watching this at 1 o'clock. Notice the weekly trend slightly up, the monthly trend's up. You wouldn't have taken this breakout here because it was underneath the hourly. Obviously that trade worked. It pulled back. You might have went long right here when it was right above the hourly, goes sideways and breaks out. You're trading in the direction of the longer term trend, and it went right back up to the previous swing high, and it did not have that much strength, and it had less strength than it did the last time. So why should this break above this area's high if it has less momentum now than it does before? It's not likely to. So maybe you made 20, 25 pips on that trade. Pulled back again, found support to hourly. It had no weakness on the way down. You might have gotten into that trade here. And then the market's, obviously breaking down underneath the hourly. That's never a good sign. If the weekly and monthly trend were down right here, you might have looked to sell right here. I wouldn't have bought down here because it's not at or below the lower containment bands. But then it goes back above the hourly, and you have a perfect wedge pattern right here with a flat bottom. This is a great trade. You're trading in the direction of the weekly monthly trend, and it came up to this area here without that much strength. You probably would have exited at the very minimum half your trade, or maybe even the whole thing. And then once it made a higher high, that's a big sign of strength. You buy the next pullback, you draw your fibs on it, and that's most of the time where the market goes to installs. You can see shot through the first one, so I probably would have got the whole trade somewhere up here around 90. I would have missed the remaining 10 pips. But you're in this trade right here at 50. It's a 40 pip move. And this isn't really enough of a pullback for me, but and technically it is an Elliott two-wave pullback, but not the best of ones. See, it came down to 1.618. You might have went long right here when it broke out at 97 and got, or not, actually 77, made 20 pips on that trade. Let's go over some of the other currencies. Dollar Swiss, the weekly trend and monthly trend are up. If this pulls back to the hourly right here, which you can see it has more weakness on the way down than the way up, you might have bought here. But on the way up, if you ever get into a buy and the market goes up and the bars are red or the FX trend intensity pro is red, it almost always is a sign of failure. So once it breaks down underneath the hourly right here, I wouldn't have sold here because the 10-day moving average was here. But once it breaks underneath there, you can give this a shot. Keep in mind the longer term trend was up, so it's very likely to stall here at one of the lower containment bands. If you're a counter trend trader or scalper, you might have got into a little 20 pip move here. But notice how it's proving to it's not willing to go back up. It's underneath the hourly, even though the longer term trend is just slightly up, just barely. When it double topped right here with almost no strength, you might have gone short here and here, and it appears that it's not going to get a bounce right here. You might have gone short, and our fib level makes a great place to get out of the trade. Nice little 20 pip move right there. This one, the weekly trend's up, the monthly trend's down. That makes trading a little bit harder. In a narrow range pattern right here, if you did short it right there, notice it's just going sideways and there's no weakness. So you would have probably got out of that trade with a break even. You can't, you want to look for buys when it's above the hourly and sells when it's underneath it. This fib level here is going to be a major resistance. And obviously it's not willing to go up. And it's in a very tight range today. You might have sold here and made a little bit. When it finally breaks the low of the day, you might have gone short here and lost. Then it pulled back up, came back down again, you went short because you're trading in the direction the day's kind of hovering more to the downside than going up. It can't get above this resistance area. And then you got this nice 70 pip move. Now keep in mind the weekly trend's up, the monthly trend's very strongly down. Usually the lower containment band's a great place to get out of the trade. Nice huge move on that one. So in some of these currencies that don't really move until they finally break out later, hours later, you might have a few small wins, small losses, but keep observing what happens. If it keeps making lower lows, this is a new low of the day, it's very likely to continue in that direction. It's a very easy method you can use for any system. Now again, here the weekly monthly trend's down. You want to focus on selling. It's underneath the gray hourly moving average. You had a pullback up right here. Unfortunately, it was very strong, so if it wasn't, I would have sold that immediately. Pulls back a little bit. It's proven to you it's not willing to go up, so I would have sold right here. It only pulled back about 20 pips, and it didn't have that much weakness. The fact that it had strength followed by almost no weakness, when it came back up to the hourly, I might have skipped on this. And normally, if the weekly monthly trend were up, I would have bought this breakout here. But the weekly monthly trend are down, and we have a resistance area just less than 10 pips up. So why take a trade with a likely profit target of only 10 pips if you're going to risk 10 pips? Makes no sense. So really, I don't see any trades on here I would have taken except later in the day when it hit double top right here. The momentum on the way up was less. The longer term trend's down. I might have gone short somewhere around here at 12, and it really didn't pan out. It only pulled back about 15 to 18 pips. Went sideways, I would have got out of that trade and probably given up on this one. New Zealand dollar, same thing. Longer term trends down. When it comes up and hits the hourly for the first time, you might have gone short here. You would have lost money on that trade. It's obviously not going higher, so when it finally breaks down here, you go short again. Did pull back about 10 pips, which is enough in our rules to actually move stop to break even, so you broke even on that trade. And normally when it goes back above the hourly, you want to buy. But you have this massive resistance right ahead of us, and the weekly monthly trend's down. So there's really no reason to buy right there. Yes, you would have or could have made 20 pips on it. But when it double topped there again, with the strength disappearing, you go short. Obviously that trade only pulled back about 15 pips, and there's not a lot of statistical weakness. So you get out of the trade, whether you broke even on that trade or made 5 or 10 pips, it's up to you. Here's one where the longer term trend's up, pulls back, doesn't quite hit the hourly. If it hit the hourly, it would be a great place to buy. There really wasn't that much momentum last night. Yesterday there was. It's kind of going sideways. You really have to buy the breakout of the high of the day, but in this case, the fib target is right there. If you did take that trade and it doesn't explode through this level, you got to get out. And so you might have made only 15 pips in this trade. The market's coming down to the hourly, not a bad place to buy because there wasn't that much weakness. It only went up about 15-20 pips. Again, hit the fib level and couldn't get above it. So I would usually at that point expect the market to reverse. If it breaks this level here, I would be looking for sells. We might have got into a short right here and lost, and it's not going down. And the longer term trend's up. You got to take your small loss, get back in it, and you can see it went up about 30 pips. So if you lose 10 and then make 20 or 30, this one never took off. This is one of the worst trend trades that we probably ever go over. But you can flip when you're wrong, and most of the time when you're trading in the direction of a longer term trend, get your loss back. Here the longer term trend's up. Last night you might have bought this narrow range pullback, and you can see it went up and kind of went sideways. There's no strength, and probably broke even on that. Came back down to the hourly without that much weakness. You might have gotten long right here and only went up about 15 pips. And this is typically what happens. If it's not going up, it's usually going to break down. You might have gone short here. Unfortunately, there's a weekly pivot right underneath it, which is one of the main reasons why we stress trade in the direction of the trend, but also analyze where the next likely profit target is, and only take trades that are likely to give you 1.5 to 2 times or more what your risk is. So your profit target's right here. The longer term trend's up. Usually markets don't move too much to the downside if the longer term trend's up. In fact, a lot of people draw fibs on down moves and buy at the next fib targets. It's a pretty decent place to look for entries when the longer term trend is this strong. When it goes back above the hourly, you might have bought this breakout right here, and it kind of went up to all this resistance up here, kind of ran out of steam. There's no statistical strength. You might have made 20 pips if you're lucky. And this is a perfect example why we use our currency meter. If the pound is slightly strong or slightly weak and the yen is the same direction, you're going to get choppy, non-trending days like this. This one you just want to totally avoid because it's been basically stuck in a fib level. There's likely to be buying here, but the longer term trend's down, so we want it to kind of break down and make a lower low, then we'd short, but it never did. So just avoid it like the plague when the longer term trend's down and it's stuck either in between two tight fib levels or inside one fib level all of itself, like this. Here's another good, perfect example of that. Stuck in between two very tight fib levels, it's very likely to chop. If it broke above there, it's only likely to go up a little bit. This is just one you should avoid today. This one, the longer term trend's up. You would have been looking for the hourly here to find support to look to buy, and it went right through it. Again, when it pulled back up here, you could have considered selling there, but we have a support level, a 10-day moving average, just less than 10 pips underneath it. And underneath that is only 10 pips more, a fib level. So why even look to trade a pair like this? CAD yen, notice also it's stuck between two fibs. And most people probably would have lost money in this pair. Just avoid them when they're like that. Maybe when they finally shoot up like this and you see some momentum, you might want to buy the next pullback. I might have taken this trade actually. Actually, I probably wouldn't. The weekly trend is down, as you can see, pretty strongly, and the monthly trend's up. So, if you did take that trade, it's not likely to give you many pips. When it goes up and runs out of steam right here at the 10-day moving average, get the hell out of the trade and be happy.